What if the numbers on a report could sway the entire economic landscape? Imagine the power of a single percentage point, or a decimal. This isn't just theoretical. It happens every time the Consumer Price Index, or CPI, report is released. This month, the CPI report delivered a fascinating narrative. After months of anticipation, the data showed a soothing trend in inflation, signaling a potential pivot point for the Federal Reserve strategy. The figures indicate that inflation is aligning closer to the Fed's long-term target of 2%. This is crucial because it influences the Fed's decisions on interest rates, which in turn affects everyone's wallet. The Federal Reserve, often seen as the economic pilot, uses these CPI figures as a compass. With inflation cooling down, the Fed might now consider pausing or even reversing its recent trend of rate hikes. This is because lower inflation reduces the pressure on the Fed to keep raising rates to keep the economy from overheating. On Wall Street, the response was immediate. The Standard & Poor's 500 index, a barometer for the U.S. stock market, surged to a new high. Investors breathed a sigh of relief, interpreting the softening inflation as a sign that the Fed might ease up on rate hikes, which generally boost stock prices. This optimism is palpable, especially in sectors sensitive to interest rates such as real estate and consumer goods. However, it's not all balloons and confetti. The same report highlighted a slowdown in retail sales. This juxtaposition of slowing consumer spending against the backdrop of declining inflation paints a complex picture. It suggests that while consumers might be feeling less pressure from rising prices, they are also perhaps more cautious about spending. This could signal a shift in consumer confidence or a strategic adaptation to a potentially changing economic environment. To summarize, the latest CPI report has provided a dual narrative. On one hand, easing inflation soothes the Federal Reserve's fears, potentially altering the trajectory of future interest rate hikes. On the other, a slowdown in retail sales could hint at underlying caution in consumer behavior. For the average person, this means a likely respite from escalating prices, but also calls for prudent financial planning in the face of uncertain economic currents. In the grand chessboard of economics, each move by the Federal Reserve, each fluctuation in the stock market, and each change in consumer behavior interlocks to shape our financial landscape. As we move forward, these indicators will not only dictate market conditions, but also guide our personal economic decisions. Keep watching these trends, for they are the subtle forces that drive our economy's future.